there's two sides of it. There's the inflation story, and there's dynamics happening there. There's also the technology story with a lot of things happening there as well. Then there's how they're operationally functioning, which is a lot of these locations went from 80%, either drive-through or in-store to 50-50, delivery models. Welcome to Inside Scoop with Sean Emery. Every week we are examining something new, bringing you closer to companies, sectors, and themes. This recording should not be construed as a substitute for personalized individual advice from Avery & Company or any guest on the show. This is for educational purposes only and not intended to make an offer or solicitation for any companies or securities mentioned. With that, let's get on with the episode. All right, the topic of du jour today is restaurants. We have always been a fan of this industry from the investment side, really, as it has created these long-standing brands, and they emerged from nothing and kind of blossomed into things like Chipotle and Starbucks and many others that have come before. What once was an industry that had kind of low barriers, and you could admittedly say still so today, is now seeing things like scale, rewards programs driven by enhancements in many digital capabilities, creating much more durable moats for those that actually get to that peak. Essentially, the bigger you are, the more resources you have to meet the customers where they want to be met, whether it's digitally or in person. We saw that with Chipotle's success years ago. Full disclosure, we were investors in Chipotle 5 years ago during that transformation. But today we have Michael Halen from Bloomberg. He is the senior restaurant analyst. And we're happy to bring you on, Michael. How you doing?
I'm doing well, man. Thanks for having me.
Yeah, I think bringing you on, it's a good timing. There's so many cross currents going on in the industry, in the world in general, but specifically in the industry. And I think what we wanted to do was, go through a couple different sections, really pick your brain in terms of how to look at this industry from an investment perspective, the health of the industry, any emerging brands you're seeing. We talk about inflation. Obviously, that's a key topic today. Inflation, and also how that pertains to automation. And I think we just spoke about that offline. But anything you could share there. So let's start with number one, I guess, talk about the industry from an investment perspective, maybe give a little, just before that, a little bit of about you, so we can gauge, who we're speaking with today.
Yeah. So, Michael Halen, senior restaurant and food service analyst here at Bloomberg Intelligence. I have a unique background. I've been trading. I was trading stocks right out of college. So I had 11 years of experience trading equities, 9 years actually running prop desks. I was a big consumer of equity research. I think there is where I kind of acquired a healthy disdain for some of the work that was coming out of the sell side at the time. We had a very technical analysis heavy approach. And then from there, I was largely automated out of a job. Black boxes really took over a lot of the human traders in the business. And since then, I've been an equity analyst for 12 years now. I've covered restaurants, food service, health and wellness, packaged foods, and department stores for a little while as well. And the volatility of restaurants and consumer discretionary in general has been a great fit for me as a former trader. I embrace the volatility, and I think I have a good ability to recognize what is priced into a stock. So it's helped me so far in my career.
Cool. So, let's unpeel that a little bit, which is, going into the industry of restaurants, how do you think about the landscape, whether it's top down or bottoms up, whichever direction you want to start, thinking of, how to invest in this area?
Yeah, restaurants are unique. It's highly fragmented, right? Market share really doesn't matter. I know everybody starts with their SWOT analysis in most of these other industries, and I could care less about market share because nobody's going to eat at McDonald's 3 times a day every day, and if they do, they're going to be pretty unhealthy. So it's not kind of how we're looking at things. It's such a large fragmented industry, but scale does matter. So as you mentioned at the top, companies with scale can do. Not only can they price a hamburger at a price that the competitors just can't match without losing money, they can also use that to help scale their technology and use that to gain market share and keep the share that they have. There's basically no barriers to entry in this business. It's a short life cycle in general, all feeding into that volatility that I spoke of. And it's also, a canary in the coal mine. A lot of investors will look at this industry, to see where the consumer is going. So I don't have any heads up about where things are going from any other industries. This is typically a place where people will look because, restaurant spending is as discretionary as it gets, right? It's much cheaper to eat at the restaurant. It's much more expensive to eat at a restaurant than it is to buy food at a grocery store and cook it yourself.
Yeah. So let's kind of break down maybe the subsegments of the restaurant industry, like everything from kind of, fast casual to fast food to casual dining to maybe high end. How do you think about maybe in a brief way, kind of those different compartments or sub segments of the industry? How do you think about each one separately from one another, or do you think about them kind of all as one when you're trying to make your analysis of brand, scale, things like that?
Yeah, from the top down, I'm looking at all of them kind of as an aggregate at times because they're at any given time, somebody's taking share from somebody else, right? But on a bottoms up type of analysis, when I'm doing my single stock research, I'm really looking at each subsegment, and how they're performing versus their direct competitors. So I really look at both, right? On the bottoms up stuff, we're looking at quick service, and that's the traditional McDonald's, Jack in the Box, Wendy's typically have a drive through, do 3/4 of the business through the drive through. The dining room is really there just to for people to go in and eat when the drive through line gets too long. Doing a little bit of delivery now, not a ton, maybe 10% of their business. Whereas the fast casuals are more of an elevated type of quick service experience, right? You typically have counter service. A lot of customization is often available at these fast casual chains. You're thinking Chipotle, but anybody with an elevated type of experience like Wingstop and Shake Shack are considered kind of in that grouping. And then you have full service. And so, from where we sit on the public side, most of the full service names, think, sit down, server, full kitchen. So most of the chains that are public in the full service realm are casual dining. So you think of the Brinkers, which owns Chili's and Maggiano's and Darden's and Texas Roadhouse and those types of chains that fit into that casual dining. But there's also subsets in full service. There's polished casual, and that's really just a little bit higher end than the names that I mentioned. Some of these chains that are maybe $30-$40, like a Bonefish, $34 guest checks. Then you have more high end like Ruth's Chris and Capitol Grill and chains like that. But I guess those are the main sub segments that we're looking at and we use to help value our companies, right? So I don't think it's always it's not a good way to it's not a good practice to value a quick service by including casual dining chains into that calculus, right? So kind of why we look at real apples to apples and oranges to oranges comparisons when we're trying to value these things.
Yeah, and I guess let's take the stair step up from kind of the fast food all the way to the polished dining in terms of margin structure. You know, one is much more service oriented. The other one is much more convenience oriented. There's different things going on there as well in terms of automation, whether it's inside the kitchen and or in terms of the checkout process. I think COVID has actually created maybe whether it's the opportunity for margin expansion through automation, futuristically outside of food costs, but also things like menu and digital menus and the likes. Talk about the margin structures potentially at a high level from kind of the bottom to the more polished players out there, and how one should think about it.
Yeah, when you look at the quick service names, they typically generate pretty good restaurant margins. You're typically in the high teens. Because they are able to automate. Obviously, those margins have been getting squeezed over the last couple of years. There's been, a ton of inflation. We're looking at, I don't know, I think high single digit labor inflation this year and mid teens commodity inflation. So the margins across the board have been getting squeezed. So now those are probably sinking to the mid teens type of restaurant level margin. Even though they have low priced items, they can automate more easily. Their labor costs are a lot lighter than they are for a lot of the other competitors of theirs. What I guess holds back some of the chains is just the volume that they do through their stores, right? So if you have, a Burger King and it's doing, 1.2 million in average unit volume, so that's their annual sales. That's going to impact their margins in a negative way because there's definitely a high percentage of the costs in a restaurant are going to be fixed, right? So that's kind of where they stand. Fast casual has done better. A big part of that is the larger sales volume. So Chipotle can run, almost 3 million through their stores on average. So that really boosts their margins because of the operating leverage in the model, right? So the stronger the sales levels, the better you're going to be. Coffee chains, when we talk about quick service, coffee chains is always an attractive one, right? Like there's some savings in the build out costs because they're not building grills and they don't have to have vents and hoods and all that kind of stuff. So and they're doing pretty big volume on high margin addictive product coffee. So margins and return on investment are pretty strong for Starbucks and some of the other coffee chains that we've covered in the past, like that have gone private, like Pete's and Dunkin' Brands and stuff like that. So there's some of the highest margin restaurants that we've ever covered. And then when you move to casual dining just it takes a lot of labor to run those restaurants, and there's a lot of variables that impact them. What we're seeing is kind of, at the high end, you have Darden, who's a rock star. They have the most scale and they're very operationally efficient, and their margins went from the low 20s to now maybe around 20% right now. But a lot of their competitors have sunk into the low teens because of the inflation that we've seen and a reluctance to price in line with inflation just for fear of losing traffic, right? And so casual dining, it's more complex. There's a lot more training. So when you lose employees, when turnover's high, turnover in this industry for hourly employees is well over 100%, 130% historically. I think it's even higher than that right now, which is pretty wild to say.
That is well.
Yes, even GMs right now, I think historically it's been in the like 35% ish range, and that's high right now too. So there's a significant, because it's more complex, there's a cost to training these employees, right? And so labor costs really hurts the casual dining and the full service type chains. So their margins, have been hit. Some of the chains we cover have, dipped even down into the low teens at a restaurant level margin. And that's much higher than the operating margin. That's probably double what the operating margin is, right? Once you incorporate marketing costs and corporate G&A and all of that other good stuff. So
yeah, that's an important thing to for the listeners, is that restaurant level margin is not including the things that essentially happen outside of the restaurant. I know it sounds like that, but just for the clarification of everybody is what does this restaurant produce on kind of a standalone basis outside of, which is why, again, you go back to scale, which I think is what you spoke about and I spoke about at the beginning, which is how scale can be advantageous for, a chain that's running thousands of locations, and a percent of marketing is much smaller relative to the size of the volume coming through all the single locations. Now, so you talked about margins, we talked at a high level around the different sub areas of the industry. Talk a little bit about the valuation process that you think of as you're looking at, again, using the same stair step, which is starting from the bottom and moving on the way up to value these companies. And, there's brand value outside of just volume and cash flow. I know that's the end all be all at some point, but at the same time, it's kind of like, what is the true durability of this business? Because you could have something like a Starbucks, margins come down because they're, refreshing their stores over a period of time, yet or some one-off costs and whatnot. But at the same time, there's this brand value that is just totally hard to ignore, and just talk about how you factor that in.
Yeah. So, I'm looking at a lot of different things. Obviously the top line growth is fueled in this industry by same store sales and net unit gains. And the pandemic has created a lot of gyrations in that year over year same store sales numbers. So we've always looked at a 2-year to kind of smooth out the ups and downs of calendar shifts year over year, of weather impacts, and things of that nature. But we now are looking at even going back to 3 years, because of the pandemic caused just so many different shifts where full service at certain times, obviously the full service was hit pretty hard. Then quick service gained market share. And then, this year we're seeing a little bit of a reversion back to that, where people are going back to the dining room. So we're going back all the way 3 years right now. Next year, I'll be looking at 4 years to kind of get a good gauge, right? Because if a chain had a really, really bad last 2 years, they have the easiest comps of anyone. And if you just look at the year over year number, they're going to look like rock stars when in fact they're trailing everybody else. So, we're going back 3 years and we're watching those trends very, very closely. Margins, restaurant level margins and the operating margins and margin potential, right? So who's trailing? Why are they trailing? Can they close the gap? Right. The easiest way to close the gap is to increase your sales, but is there low hanging fruit for whatever reason? But so that's something we're looking pretty closely at. An interesting one over the last couple of years has been Bloomin. Their margins had trailed their casual dining peers for years, and this was constantly an opportunity, right? Like we have an opportunity here, we have an opportunity, and they weren't really able to capitalize on it. But over the last couple of years, man, despite the pandemic, they've been able to really widen their operating level margins and not only catch up, but surpass a lot of their casual dining peers, and they're actually above average right now. So, kudos to that management team. Really, really did a great job. I'm looking at, how fast EPS are growing, right? What's the dividend yield? The balance sheet, I'm looking for what kind of leverage are they operating with? Are they operating with? Are they under levered? Should I be concerned about the amount of leverage? Do they have net operating loss carry forwards on the balance sheet? Something that can help them ramp up share repurchases, which is, people throw a lot of shade at share buybacks, but in the restaurant business, we have a bottleneck, and that's labor, right? So you can only grow your chain so fast because there's a shortage of labor in the industry, and there always is. There's always a shortage of really good employees, especially good managers. And one of the biggest correlations between a restaurant level success is having a very good, experienced general manager. So because of that bottleneck, share buybacks are a great way to return capital to your shareholders. Dividends as well, but net operating loss carry forwards have been, in my experience, a pretty good tool that companies have used to help accelerate the buyback and return cash to shareholders that way. Free cash flow, obviously, cash is the reality of the business, how much cash they're generating. In this business, how franchised are you, right? A franchise business is a more solid business. It's easier to predict their earnings and cash flow. It's much higher margin. It's asset light. And so the more franchised you are, as long as you have healthy franchisees, the higher multiple you're going to get in the market, because it's a safer play. There's a lot less operating leverage in that model versus a company that's 100% company owned. There's a ton of operating leverage in that, man, and a lot of fixed costs. So, your sales same-store sales drop 5% year over year, your margin's going to get clipped hard, right? And that's, a concern, obviously, right now with all the inflation that we're seeing and potentially being in a recession. So, the franchisees have a little bit of a buffer. Nobody gets away scot-free. Franchisee health in a recession is always a concern. Look at a company like Domino's. There was a lot of concern about the health of their franchisees during the great financial crisis. They did a phenomenal job coming out of that, but that's a real issue. But the amount of franchising in your system is definitely critical to analyzing this company. And then when you're looking at franchise stores, I look at it like a franchisee. My mentor always taught me money flows to where it's treated best. And so if I have the opportunity to open a McDonald's, a Jack in the Box, a Wendy's, Raising Cane's, a Zaxby's, some of these like hotter emerging chicken
I saw
chains.
Raising Cane's the other day in Austin.
Yeah. Yeah. A Hop Dotty stuff, some of these hot brands, if you have a chance to franchise them, you're going to look at the unit economics. What's my sales to investment ratio? What's my return on investment? What's my, what kind of revenue per store am I running? What's the labor requirements? What are my margins, right? What am I going to make off this? And so that's kind of how I look at these franchise chains when I'm trying to figure out how fast they can grow, is like, how attractive are you to franchisees? And a question that I often ask is, what percentage of your new franchises are opened by existing franchisees? And I like to hear when they're telling me 75% or above, because that means the franchisees are happy, right?
Sure. Yeah.
That means the unit economics are strong, and they want to put that cash to use. And I'd say another one would be like, how, what, like I mentioned, buybacks, but how are you using your cash? What are the returns you're getting on your investments, whether it be tech, whether it be share buybacks, uh, things of that nature. Are they going to be responsible stewards of my capital?
Yeah, I guess the franchisee comment was super important. I guess during COVID as well, where again those that had when you go to zero, they can waive some of these fees, but you don't have that fixed cost that many of the non-franchisee kind of stores. Obviously, people kind of adapted and quickly tried to do takeout and pickup and things like that.
But the
Now,
landlord still wants his or her money
yeah,
at the end of the month, and you have bills to pay, right? And so,
sure.
yeah,
Yeah, that was also important as well from a concentration risk standpoint of, it's good to have really good franchisees, but it's also the risk goes where, you have a tight knit group of franchisees that necessarily there's concentration risk. I know that was brought up a lot during that period. Again, it probably comes up the most when things are tough. Because again, you have one bad franchisee that's going through some form of distressed something because you don't know their leverage. There could be an issue, but again, if they're running it successfully, there's probably always a buyer on the other side of that.
yeah, and that's where it helps to not be too levered, right? Most of these chains have the right of first refusal, so when their franchisees are struggling, they have the first
Pick it
right to
up.
come in and pick it up, fix it, and then refranchise it later down the road if they so choose. So that's where you want to have at least some flexibility on your balance sheet to take advantage of things when they arise, right?
Sure. Yeah. So let's go to the next section. I think that was a really good like introduction to the industry, which is, what again, I'm just reiterating it for everybody's purpose, which is, what's the dynamics of the industry, kind of like what does each section or segment serve, literally. And then the margin structures, the flexibility there in terms of, more people oriented versus convenience and technology and G&A oriented versus, the next phase is really around what drives, margins, which is same store sales on a fixed cost base, and that'll flex your margins up or down. On top of everything like food costs and so on. So let's get to the industry today, the health of it. There's things like there's two sides of it. There's the inflation story, and there's dynamics happening there. There's also the technology story with a lot of things happening there as well. Then there's how they're operationally functioning, which is a lot of these locations went from 80%, either drive through or in store to 50-50, delivery models. On top of that, and maybe we get to it, which is ghost kitchens, which is, you hear that from Darden and some others kind of creating things inside of utilizing their kitchen to its full capacity and creating sub brands outside of that. So I know that was a lot there, but basically the health of the industry, and I'll pick apart anything that we didn't cover.
Yeah, there's a lot of stress on the industry, right? I mean, we went from out of the frying pan into the fire, right? The first concern was, especially for the full service chains, first concern was like, what are we going to do? Sales are down 60%, right? And then you finally got to a point last year where sales had fully recovered in all segments of the industry. Casual dining finally caught up, full service finally caught up, and got into positive territory versus pre-pandemic. And as soon as they got out of that, inflation hit. So last year still turned out to be a really good year. And a big reason why was because the restaurants were so understaffed and people still wanted to go out, that margins were great. Last year was a really, really great year for a lot of the chains we covered. They generated record free cash flow at many of these chains and record earnings, because they just didn't have enough people in the restaurants to handle all the business that they were getting. And so, although it hurt the experience, which long term isn't a good thing because
Right.
it'll turn people off, but people were just so excited to get back out and see friends and family, and a restaurant is a perfect place to do that. It's such a popular place to do that here in the States. And so it turned out to be a good year, but this year has been different. So we're getting pretty close to being full staffed at almost all of the restaurant chains we covered. And it's not full staffed. I'm going to say we're getting back to we're getting back to pre-pandemic levels, right? We're getting back to that like 95% ish staffed, and we're getting close to that. So now we're fully staffed, but it's been very expensive. Labor is up high single digits this year. Commodity prices are up, mid single digits this year. And so, restaurants are very careful to price that into their menu because, they know it'll turn people off and people will start moving back into the grocery stores and stuff like that. And so they've been kind of taken in on the chin a bit here on the margin side. And then also, as you mentioned, demand has changed so much this industry has changed so much over the last couple of years. And, we talk about it a lot, but, it accelerated all of these trends, right? Like the working from home trend and the, delivery trend. And so there's been these huge shifts where restaurant chains, their restaurants that were monsters in the cities and urban centers are now, down big still versus pre-pandemic, and their suburban stores that were struggling to hang on are now knocking the cover off the ball. And you're seeing ghost kitchens now. Investment has been huge, and you're seeing those ghost kitchens pop up in the suburbs to kind of meet a lot of that demand, and a lot of chains using them to ease some of the pressure in the restaurant, right? Like these restaurants weren't built to do 25% takeout and delivery. Like they just weren't, like the industry was doing, half of that pre-pandemic. And, a lot of the full service chains, they don't want Grubhub or Uber Eats drivers like clogging up their lobby. And, the kitchen's not set up for it. And so it's just caused, there's been so many, it's created a lot of complexity, a lot of just complexity and issues for these restaurant chains to try to figure out on the fly, right?
Yeah, no, that makes a lot of sense. So obviously there's, I look at a list here and I'm looking at commodity prices from the year to date highs, right? So I know it smooths out. How quick? So everything from avocados down 63% from its year to date highs. Chicken wings, we've seen that with Wingstop. I mean, they're like actively saying that their prices are lower than everything else, which is a smart move.
Mhm.
Everything from oats to I'm just going down this list, but box beef and I don't know the
Chicken.
implications there. Yeah, just different categories. So like the method that they've done so far is essentially hold their prices at a pretty reasonable level, don't increase their consumer price relative to the size of the input costs that they saw. Commodities ebb and flow, we've seen that. You think it's more of a function of them investing through that cycle, seeing this as more cyclical than any sort of structural change? And what we've seen, I think, in the past is when avocado prices go up or down, Chipotle's guacamole goes up and down. Therefore, just trying to get your perspective of a year from now when potentially prices for commodities ebb and flow, whether it's they continue their path where they are now. Does that offer the opportunity for margin expansion? Does that offer the opportunity for some of the chains that raise prices to then kind of take it down? Is there that wiggle room, or is there's something in the restaurant category where once your price is a price, it kind of never goes back down?
It's you mentioned two that tend to fluctuate a little bit,
Sure.
wings and avocados. For the
That's not what
most,
you eat every weekend? That's
I mean, I eat a lot of both of those, to be
yeah,
honest. They're both fantastic, but those are two that you will see because they're pretty volatile.
sure.
At different times of the year, there's seasonality to them. So you'll see them pricing up and down, but in general, I don't think you're going to see menu prices drop. So, you know, it's tough though, because if the commodities drop, that could be because we're in a
Man,
recession,
right.
right? And demand drops. And so that's kind of how I'm thinking about the next year. I expect demand to drop. I expect traffic to drop in the industry, and I expect some easing of those commodity prices. But since these chains haven't increased their prices enough to keep up with the inflation that they're seeing, it's going to be kind of a give and take, right? They're going to benefit from this cheaper costs, but then they're also going to have to start discounting a little bit more. And we're already seeing it with some of the chains that we cover because the low income consumers aren't visiting as often. So, Shake Shack's running their first happy hour special first special in its history, doing a happy hour special. And, KFC is running discounts right now for their low income consumers. They added mac and cheese bowls and other lower cost items to try to bring those low income consumers back in. So I see kind of a give and take where what the gains that they could make because of the lower commodities are going to be offset by
Discounts.
by discounting and by just lower, the impact of sales leverage. If sales go down, it hurts your margins, as we talked about earlier. So it's kind of a give and take there, and it's a tough one to figure out. Longer term, I'm not an expert, but in my past, I traded a lot of commodities. I mean, it sure feels like we're in the early stages of a commodity bull market. The last one lasted about a decade. Um, we've seen very modest commodity price inflation for 10 years, and now it seems like we're in the early stages of another one. Those ebb and flow with the economy, right? With the potential recession, but over the next 10 years, I think we could see a lot of commodity inflation, and it's a big reason why you're seeing restaurants finally invest in tech and invest in automation to try to offset some of these costs they see coming down the pike.
Yeah, that was going to be my next the next section here, which is really around what you're seeing from the operators in terms of automation to combat some of this stuff. I think it was inevitable in many ways. Maybe the price points weren't there, so therefore, the return on that investment wasn't there. But obviously, as the price of things go up and down, and there's bouts of inflation, so talk about what kind of tools you're seeing kind of start to creep into these chains, and ultimately what you're hearing anecdotally about what that means for future return on that investment dollar relative to, let's just say, it's getting rid of one employee for four terminals, and or pick up, takeout, drive, Shake Shack with their drive through. And Chipotle even has kind of, they have their Chipotle lane, but they're basically trying to, they've ran tests in the past around true drive-through experiences. It's just again, think about the automation equation here and what you're hearing from the technology.
Yeah, that's a great question, and you bring up a good point there, right? Like, there's at first the technology is very expensive, and there may not be an ROI on it, but eventually there will be, right? As labor costs continue to rise and as the technology costs fall, right? A good example of that is server handhelds, which are becoming ubiquitous here in the States, but you know 4 or 5 years ago, when Brinker's Chili's was one of the first to kind of start using these server handhelds, and like I think it was probably around 2016, 2017, and they were only using them in LA and Seattle and places where minimum wage was $15 an hour, because it was the only place that had an ROI on it. But now they've rolled them out to the entire country because the cost of the technology has fallen, and obviously wage rates have increased in the industry. Now is paying more than minimum wage just to attract talent. So I think we're going to continue to see that in different ways. And kiosks, I think, are going to be ubiquitous. It's interesting. People didn't want them, 6-7 years ago. Jack in the Box, I had them and people didn't want them and they took them out. And now
it's funny.
And then McDonald's, like you mentioned, their scale and how they went from a technology laggard to a leader in just like a few years under their previous CEO, Greg Easterbrook. And, they rolled out kiosks. I think by the end of this year, they'll have the entire United States on kiosks. And I think, and I think they're going to
just break that down.
13,500 stores, man. It's a big rollout.
What was the replacement there? Like, do you know the dynamics of like how many people are in a store versus how many kiosks are in a store?
They haven't. I'm not sure, to be honest. They haven't really given us good color on that. But I think we're going to see them everywhere. Shake Shack has been installing them in all of their stores for a few years now, all of their new stores. It makes a lot of sense because younger generations want to use it. Everybody spends more when they use it, right? They don't feel that pressure of people like behind them, like
the timing pressure,
like hanging on their neck, and it's like, just give me a number 2, whatever, like they have the time to actually customize their order a little bit more, which increases the check, right? They have time to add for add-ons, and then they could do the suggestive based selling through it too, right? Like, oh, you might like this. McDonald's can pitch McFlurries because it's 100 degrees outside, and things like that. So it's really quickly become a no-brainer. I'm going to bring up McDonald's again, but they have been doing, I think they're always doing work on how many steps in the kitchen your cooks are taking, right? And so trying to reduce the amount of steps that they need to take, trying to increase the amount of burgers they can cook at one time, like all of these kind of things to try to reduce kitchen labor. And so a lot of these chains are improving they're spending money to improve the kitchen equipment that they have, and to make, quote unquote, make their employees' jobs easier, but also they're not going to admit it, but also to reduce labor in the kitchen and in the front of the house. So, yeah, I mean, you see all these examples in California, obviously, which has been dealing with higher labor costs than the rest of the country for years now. The chains that are based out of California, man, they're working hard on automation. You have Chipotle working on Chippy, they call it. It's an AI robot that makes tortilla chips, and Jack in the Box has automated fryers that they're testing right now in some of their San Diego locations. So automation is going to be the way out of this for the restaurant chains. I mean, listen, man, it's not a high margin business like we're talking about. After a 15% operating margin, and then you're paying the corporate level expenses and marketing and everything else, what are you left with? A mid to high, net margin. It's
Yeah.
not a high margin business. And so when you're seeing the inflation you're seeing, and you have to take some of that commodity inflation on the chin, and your labor's going up 8% this year. Darden thinks between now and middle of next year, they think labor inflation is going to be another 7%. Right? Like before, we used to just be able to look at, who's raising their minimum wage, which states are raising their minimum wage, and by how much, and then how much do these each company have, how much exposure do they have to those states, and we could kind of get a feel for how much their labor cost. But now, with labor being such an issue to find labor, it's like a wild card, and we're seeing these high single digit increases year after year, and it's tough for a low margin business to absorb those costs.
Yeah, that makes sense. It goes back to a general philosophy we have is where, humans tend to adapt, meaning management teams in the investment world. But, during COVID, there was zero volume coming to your store. So guess what? You turned into a delivery, pickup, whatever you wanted business, delivery alcohol business. If you served any alcohol, you became a butcher and a meat distribution company.
Yeah.
And that evolution, now you have the pickup of inflation and the cost of, employees, and that's sending the next evolution where these companies adapt and evolve, and with a main goal of maintaining margin. So it's this continued evolution of whatever you face with, you adapt and you evolve. And I just think that's always an important message, no matter the industry, but broadly speaking, as if you invest in a good company with a management team that has the ability to make bold decisions, execute, think independently, and make the right calls. I think that's ultimately where you get the Starbuckses of the world, and some others.
Yeah. Texas Roadhouse is one that was, I mean, they were doing almost no takeout. It was like 6% of their business. And it was like mainly people like bringing something home for somebody else that couldn't make it to the restaurant. Right. So, they absolutely crushed it during the pandemic. Never did any delivery, still refuses to do delivery. Right. But they brought that like Texas Roadhouse ethos into the parking lot, and they were doing line dancing in the parking lot and having parties in the parking lot. And like you mentioned, they were one of the ones that created the online butcher shop. And, they went from almost no takeout sales to a nice chunk, to it being a nice chunk of their business in almost no time. And so I think this business in general is very entrepreneurial. There's a lot of ingenuity, especially at the restaurant level and the GMs, and and it's a resilient business because it's not, as we're talking about, it's not easy. It's not an easy business, and so the people that succeed in it, have seen a lot. Right. And so that's part of the reason why I love this business. I mean, the culture of the people in the business is phenomenal. Everybody's so hospitable. Everybody helps each other. Like it's not like a cutthroat business. I guess part of it is just it's so big, and you're not always competing. Your competitors are so diverse, and it's not only the restaurant next door to you. It's the grocery store and the convenience store, and the ballpark, and a million different other places where you could kind of get food. So
Yeah, I remember when Chipotle was coming fast, and so were some other, the Lime Freshes of the world, and that whole like Mexican cuisine, Tex-Mex cuisine. And you had someone like a McDonald's basically start selling burritos and different types of things, and then they took it all off their menu, and their unit volume is much higher then. And it just goes to show you how big this industry is. While McDonald's went on the defensive for a moment, they actually realized, let's just do our core business for the most part, and we'll be fine.
And it's really turned the business around.
Right. It's pretty wild. Yeah. So a couple more areas, I think I just wanted to make one note on that automation or that experience you talked about, which was around that digital experience when you're at a kiosk and it's personalized, that is the ultimate open door now for a rewards program, for a relationship that you can build, whether it's communication directly, discounts, things like that. Um, I think that is such a big thing going forward in this industry, which again, we've been down the door with their names, but Starbucks and Chipotle do a really good job at building rewards programs and or pickup experiences that work. Starting with digital, I think the number is like what, several billions of dollars of a gift card inside of Starbucks
Yeah.
ecosystem still that haven't been spent. Just talk about the opening door here for these relationships that can be built with these brands that didn't exist like 15 years ago. There was relationships, but I think now you're getting one where if you accumulate enough rewards, like you're kind of it's like hotel chains in a sense. Just talk about that kind of change and dynamics on a go forward basis.
It's a huge opportunity, and the chains that are figuring it out, and we're still not even really there yet. But the chains that are the furthest ahead, think Starbucks and Chipotle over the last couple of years, and Domino's, which they've been
Yeah.
struggling a bit here because their drivers are would rather work for Grubhub and DoorDash and Uber Eats because they just have many more deliveries and they can make more money. But that's another one, But Starbucks was probably the first to create an app that really changed, and a loyalty program that really changes people's behavior. Domino's is another one that was ahead of the game in terms of the one-to-one marketing, right? But I mean, to your point, people are walking around with a billboard in their pocket, right? As opposed to just spraying money all over media, TV, and radio, and hope that people that are interested in your brand like get wind of it and it impacts their behavior. You know, you can directly advertise and give discounts to people at the times that they want and need them, right? Like they know me and my son like to go out to eat on a Monday night, and they could send me something like at 4:30 right before I go home. A restaurant could send me something right before I go home, like, hey, whatever, this is the discount we have, buy one get one, whatever, if you come in tonight. And as opposed to just more broad reaching discounts that often what you're doing is just giving people a discount that we're going to come anyway, so you can kind of really tailor your messaging, tailor your advertising to, a different archetype or to somebody's behavior. And it's not easy to do. The
Right.
chains aren't fully there yet. They're getting better with it. You know, that they've created customer archetypes, and they send different emails to different archetypes depending on what their habits are. But the chains that can really figure it out, that can take all of this data, because everybody's inundated with data and most chains don't really know what to do with it. But the chains that can figure out what to do with all of this customer data and how they can impact their customer behavior are going to continue to be so far ahead of the competition. I mean, over the last decade, if you look at a Panera, a Starbucks, and Domino's, I'd say digital is probably 80-90% of the reason why they've outperformed their peers by so much.
Yeah, that makes a lot of sense. We always start with like what brands have like a cult like following, and that's like ultimately the ability. Now that kind of speaks to this last little section here, which is emerging brands. It's really those brands that are building something, call it cult like in a lack of a better phrase, I guess. Something where it resonates with consumers, whether it's experience, brand, food, probably the combination of all. To be honest with you, and value, I guess, oriented in terms of what the perception is to the end user. Just talk about any emerging brands that you see, and then you alluded to some on the more negative side, but we'll stick with mostly emerging brands, and then a couple of some dunks on some other companies.
Yeah, we there's just so many. I'm familiar with so many, and there's so many different things. A friend of mine, Lauren Bailey, runs uh, a chain of wine bars in the Southwest, primarily Arizona. I think she's got some in Colorado. She's moving into Texas, and the food and the service are phenomenal. They have good wine at a very attractive price point. It's a cool spot, good music. Um, and it brings in kind of a younger crowd, which a lot of these emerging brands are trying to do, she does a nice job about it. I mentioned Hop Dottie, which is a burger spot that does a nice job as
Oh, wait, I
It's like
had that
counter
the other day.
service.
You know that?
What's that?
I did have that actually, in Austin.
Oh
Uh,
yeah, the fries are phenomenal, aren't they?
yeah, yeah, it was good. Someone told me to go there, and it was one of the only things open, and on this one street that everything was happened to be closed really early, and it was delicious, actually. Wow, I didn't know it was
Yeah.
actually. I thought it was just on the street.
Yeah, no, they've I don't know 50, 60 locations or something now, and there's some tacos spots out of the Texas area, Torchy's Tacos, Velvet Taco. A lot of these um, kind of elevated food and service type fast food or fast casual type spots. And then there's places. I think we talked about Naya and Bolé and some of these spots that are kind of um, hitting on healthier for you type of things, right? And so
Yeah, they're almost
Mediterranean and
yeah, they're
bowls.
almost taking like the Chipotle operational intensity. You walk through a line and counter and build your own thing, but just recreating the flavor palette
Yeah, with the just
profile.
different cuisines, and so that everybody wants to find the next Chipotle, man. I mean, that was a monster, and it continues to be. I mean, their sales are up 30% on a 3-year stack basis, man. I mean, they're absolutely crushing it. They hit on the sustainability aspect. They give money to charity, and it's better for you. They care about the environment. You can eat healthy in there if you like, right? And so they've been able to hit on so many of these trends, and you see a lot of these emerging brands trying to hit on at least a couple of those things to help kind of create some hype and create that cult following, right?
Sure. Cool. I think that is where we should wrap. We've been talking for a little bit here. I think very informative from the beginning of understanding what to look for in this industry in general. What are some of the trends happening? I think the best way to phrase it again is kind of evolution, or they adapt. It's an industry that adapts. Digital is transforming the industry for how you either communicate with the brands or experience the brands or use the brands in general. And then lastly, yeah, there's so many up and coming brands coming up. I think actually start with digital, which is an interesting thing
Yeah.
where, they're building these loyal followings at like a scale of 30, 40, 50 locations, starting with digital first.
And you could do it right from the beginning. It's a lot harder when you're a McDonald's and you're layering all of these different technology pieces into the business, and then you have to retrain your employees. But when you can create, and Kava is one that I think about, and they've, I didn't mention them, but they're not so emerging. I mean, they're pretty big now, but they from the beginning created these restaurants that are pretty tech heavy, and a lot of and when you do it from the beginning, you can kind of do it right,
Yeah. Yeah. I mean, you can make it part of the brand, right?
Yeah.
I think that's the whole thing is
Yep.
that's why probably the older brands weren't able to, because, people just wanted their yellow wrap of McDonald's cushioning around it. And the experience was this old school, or at some point it was old school kind of, burger joint that you had this nostalgia towards, and, going toward with a kiosk totally changed the experience. So, starting with that experience first and going up again, it shows how these brands can scale much quicker, build audience much faster. Sweet Greens, I think, is a pretty good one as well, that it's done a successful job there. But we will stop there. I think that was awesome, Michael. Thanks for having you on, and coming on with us. And for your sake, if where to find you, if people wanted to learn more. I know there's a lot of Bloomberg terminal users probably listening in as well. It's a
Yeah.
pretty easy place to find you. But generally speaking, people to learn more about Michael and what you're doing. I know you guys have a cool podcast, Choppin' It. I listen to it. So yeah, anything you wanted to share before we wrap?
Yeah. All right, cool. Yeah, we're chopping it up right now. If you go on SoundCloud, you can find us. Just search Bloomberg Intelligence, popular podcast, and you can find our podcast there right now. We're still in the process of getting it up on Apple and Spotify, hopefully soon. My spelled Halen. So Mike Halen at Mike Halen is my tag on Twitter. You could search me through the bio function on the Bloomberg terminal, or same thing, Mike Halen on LinkedIn.
Cool. And if you ride bikes or do anything outdoors, he's your guy. So cool. All right, Michael. Appreciate it, man.
Thanks for having me, Sean.